Hello students, this is Padmavati Ingargi, Assistant Professor of Management. I welcome you all to the 17th session of Advanced Financial Management. Today's session's topic is calculation of equity share capital, cost of equity share capital. The outcome of this session is to make you enabled to calculate the cost of equity stock. In previous session, I have dealt with the calculation of cost of preference share capital of redeemable preference share and irredeemable preference share, and the situations like when preference share is issued at par, discount and at premium. In today's session, we'll calculate the cost of equity capital. So, cost of equity capital is the rate at which investors discount the expected dividends of the firm to determine its share value. As you all know that equity shareholders are the owners of the company. They have the voting rights in the company affairs, and these are the real owners who bear the risk, who bear the losses and also enjoy the profits. Theoretically, the cost of equity capital is described as minimum rate of return that a firm must earn on the equity financed portion of an investment project in order to leave unchanged the market price of the shares. So, in order to keep the market price in a better position, it is the cost of equity is the minimum rate of return the firm must earn on its investment. So, cost of equity is calculated through the following approaches. One is dividend price approach, another is dividend price plus growth approach, earning price approach and realized yield approach. The formulas to calculate on the different approaches we'll see next. Dividend price approach. The cost of equity capital will be the rate of expected dividend which will maintain the present market price of equity shares. So, in dividend price approach, it is the cost of equity is the expected dividend, rate of expected dividend which will maintain the present market price of equity share. So, the formula is K is equal to D by NP, where K is cost of equity capital, D is dividend per equity share and NP is net proceeds of an equity share. Dividend price plus growth approach. The cost of equity is calculated on the basis of expected dividend rate per share plus growth. Here we are calculating the expected dividend rate plus the growth in dividend. It can be measured by the following formula, where cost of equity is dividend plus NP plus G, where D is dividend per equity share, K is cost of equity capital, G is growth in expected dividend, where there is a growth in dividend year after year, that is rate we have to take into consideration, and NP is net proceeds of an equity share. Under earning price approach, cost of equity regulates the market price of the share. It is based on the future earnings. Here we are considering the earnings forecast of the equity. The formula for calculating the cost of equity in this approach is K is equal to E by NP, where K is cost of equity capital, E is earning per share and NP is net proceeds of an equity share. In realized yield approach, here we are computing the cost of equity by the formula PVF into D, where PVF is present value of discount factor and D is dividend per share. So, let's take some problems based on equity capital. A company issues 10,000 equity shares of 100 each at a premium of 10%. The company has been paying 25% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. The 25% it is expecting the same 25% in the future also. Compute the cost of equity capital. Will it make any difference if the market price of equity share is 175? The solution is K is equal to D by NP. So, this is dividend price approach method. So, D by NP, where D is dividend rate, that is 25%, divided by NP, that is net proceeds, that is 100 at a premium of 10%. So, 100 plus 10% of 100 is 110. So, 25 by 100 into 100 is 22.72%. Next, in this question, another question is there, will it make difference if the market price of equity share is 175? So, K is equal to D by NP. So, D is dividend rate per share, that is 25%, divided by NP is 175, because NP means here market price. So, it comes to 14.28%. Yes, there is a difference. When we take net proceeds, that is 22.72%. If we take market price, 14.28%. Problem number 2. A company issues 20,000 equity shares of 100 each at a premium of 10%. The company has been paying 20% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. Compute the cost of equity capital. Will it make any difference if the market price of equity share is 180? It is same as previous problem. K is equal to D by NP, where NP is 100 plus 10% premium is 110. And D is 20% dividend. So 20 by 110 into 100 is 18.8%. The market price is 180. So D by NP 20 by 180 into 100 is 11.11%. Problem number 3. A company plans to issue 10,000 new shares of 100 each at a par. The flotation costs are expected to be 4% of the share price. The company pays a dividend of 12 per share initially, and in growth in dividend is expected to be 5%. Cost of new equity share we need to calculate. And another question in this problem is, if the current market price of an equity share is 120, calculate the cost of existing equity share capital. So cost of new equity share, this is based on dividend plus growth approach. K is equal to D by NP plus G. D is 12 per share, that is 12 divided by NP is 100. Minus flotation cost is 4% of the share price. One share is 100 rupees, so 100 minus 4, 96 plus 5. Growth in dividend expected is 5%, so plus 5. 12 divided by 96 plus 5 is 17.5%. Then cost of existing share we need to calculate. Here the market price they have given, that is 120. So D by MP plus G, D is 12 divided by MP market price is 120 plus 5 is 2%. Problem number 4. The earning per share is 18. This is earning price approach. Earning per share is 18 and the current market price is 150. Compute the cost of equity share. The formula is K is equal to E by NP, where E is earning per share and NP is net proceeds. So E by NP, they have given market price, so we need to take market price here. 18 divided by 150 into 100 is 12%. In this, after calculating the cost of equity, we need to see even the cost of retained earnings. So retained earnings is one of the source of finance for investing proposal. It is different from other sources like debt, equity and preferential. Retained earnings is a part of profit which is retained in the company, where we are not paying that profit as a dividend, we are retaining it for future investments. So cost of retained earnings is the same as cost of equivalent fully subscribed issue of additional shares, which is measured by the cost of equity capital. The same as cost of equity capital. And formula to calculate retained earnings is KR is equal to K into 1 minus T into 1 minus P. KR is cost of retained earnings, K is cost of equity and T is tax rate, B is brokerage cost. It is the cost of retained earnings is same as cost of issuing the additional shares, which is measured by the cost of equity capital. Problem number 5, based on retained earnings. A firm's retained earnings KE is 10%, the average tax rate of shareholders is 30%, and it is expected that 2% is brokerage cost that shareholders will have to pay while investing their dividend in alternative securities. What is the cost of retained earnings? Solution. Cost of retained earnings formula is K into 1 minus T into 1 minus P. So K they have given in the problem 10%, into 1 minus T tax rate is 50%. And brokerage is 2%, that is 1 minus 0.02. So this is 10% into 0.5 into 1 minus 0. Here the tax rate is average tax rate is 50%. It is 50%. I have written wrongly as 30%. It is 50%. So 10 into 0.5 into 1 minus 0.02 is 0.98. So 10 into 0.5 into 0.98 is 4.9%. Next problem is a firm's KE is 20%, the average tax rate of shareholders is 40%, and it is expected that 2% is brokerage cost that shareholders will have to pay while investing their dividend in alternative securities. What is the cost of retained earnings? So formula to calculate the cost of retained earnings is KE into 1 minus T into 1 minus B. K is 20%, 1 minus T that is 40% tax rate, 1 minus 0.4 and 1 minus B that is brokerage cost is 2%, so 0.02. 20% into 0.6 into 0.98, it is 11.676%. So students, this session is based on calculation of cost of equity and also cost of retained earnings. Thank you.